Well, good morning, early birds. It's great to see you on this crisp Saturday morning here in Michigan, and I know that many areas of the country are equally crisp. I think you might be in for a little bit of a treat today. We put together a series of a few webcasts that took advantage of some time we had on our hands to attempt to put together some interesting stuff. And what I thought we might experiment here with just a few things is first of all, just the notion of having almost an investor fair-like atmosphere. We have three classes or three webcasts scheduled for today, a couple this morning, one this afternoon. And it's for me, it's basically no more challenging or different than moving from room to room at one of our national events. And simply just a few keystrokes and we go from one to another. It's an opportunity for you guys to kick around some things. We'll be interested in your feedback after the session as to whether or not you would recommend it to friends or colleagues, and also any other subjects that you'd like to see us cover. I got to say, as I put the stuff together on this one, it was actually pretty interesting and quite reaffirming from my perspective as far as, what are we really trying to do here? What lessons can we extract from history? How have we done? All that kind of stuff kind of fits into the mold, but we're going to focus in on what we do with respect to fundamental analysis and building forecasts, building expectations here for a few minutes. Well, again, a special welcome to those of you who may be new to this. My name is Mark Robertson. I'm a founder and managing partner of Manifest Investing. I'm joined here by my co-founder, Kurt Kowitz. He'll be manning the back room and monitoring for your questions. And again, if you have a comment or if you have a question along the way, we welcome that here. And if you have a microphone, you can simply raise your hand. We'd be glad to unmute you and include you in the discussions. If you don't have sound equipment or a microphone, you can enter a question or a comment by clicking in or typing in the questions tab. So with that, let's kind of get underway here. First, we just simply have to make the point that we'll be talking about some real companies, real time today. No investment recommendation is intended. Everything we do here is for illustration only, educational purposes. We are somewhat known for our willingness to demonstrate and live out the things that we talk about. Essentially, walking the walk with you guys. I'd like to start with a very simple question. We do this very often at our face-to-face sessions. We were just at sessions in Wichita, near Kansas City, St. Louis, Ken Kavoulas down in Cincinnati today. We continuously urge the audiences to think about, why are we here? I mean, why are you there on the other end of this discussion this morning? And we usually get the politically correct answers of, I want to learn, I want to do a variety of different things, but the real reason is because we want to improve our results. We want to make our long-term investing experience as positive and successful as possible, and we do much of that we do by learning from the lessons of history, leaning on our friends and colleagues around us to show us the way, especially those that have been there before. So again, why are we here? The answer is we're here for the returns, and we measure our success by the returns that we achieve. And in this community of long-term investors, we have long been taught to aim for an advantage or a performance differential, however you want to characterize it, that's incremental to stock market performance. Because again, if you can't achieve or reach for those type of levels, I mean, you could just simply buy an index fund and go do something different. I mean, we can put together presentations which show why that might not be the best idea at all times. I remember Ralph Acampora on the stage in Detroit a little over 10 years ago talking about how index fund investors were going to get killed. And lo and behold, we had the lost decade, and it turned out Ralph was pretty prescient about that situation. But why are we here? It really is quite simple. We are here for the returns. We should be focused on the returns and the things that we know have historically been fairly reliable at leading us to incrementally better returns. So that is the answer. That's why we're here. So let's talk a little bit about, again, We'll sprinkle in some of the wisdom of crowds. Again, we talk about our community. I almost think of our couple thousand subscribers as one large investment club. But what returns? And we want to put that in context. You know, what returns are we talking about? How can we take a look at results and targets and objectives and all that kind of stuff and put it in a little bit of context? We'll also take a look at, and this is some of the stuff I found kind of fascinating to actually spend some time digging in a little bit deeper. It's an area that I've been studying for a little over a decade now. You know, this notion of how successful our community has been over multiple decades. And again, the modern investment club movement goes all the way back to 1941, perhaps even a little bit before that if you wanted to really get into it. So we're talking about 6, 7, almost going on 8 decades of people doing this sort of thing. And we want to focus in on how do we do it, and then get specific. How do we lean on friends? How do we lean on this large investment club atmosphere, this community, and how do we basically glean ideas and opportunities, recognize threats, all that sort of stuff. That's part of what we're going to be talking about all day long. And again, you're welcome to chime in and ask any questions. Let's go ahead and start with one of those larger, more famous clubs. I've actually been a member of this club in the past, and the club is known as the Mutual Club of Detroit. Again, it's one of the founding clubs of the National Association of Investors, kind of one of the cornerstones of the modern investment club movement, formed in Detroit back in 1941. And I was actually a member of this club from 1997 through about 2005, maybe 2006, almost 10 years. So got to experience it up close and personal. But the powerful message that I take away from this, when we talk about the club performance contest that we used to have, the portfolio reviews and the performance reviews, when we took a look at the performance of the Mutual Club of Detroit, again, based on the unit value of the club over time, and we actually broke it down into rate of return for what we're looking at here, the stock market between 1941 and 2001 actually increased at a rate of about 10% per year. That's what you see here, this red bar. Well, during that period in time, Tom O'Hara's club account actually went up close to 14%. So again, over a period of 60 years, certainly no flash in the pan. And again, keep in mind, Tom was contributing I believe it was $20 per month every single month since February 1948. And I mean, I actually witnessed his club was in 7 digits, over $1 million. He had contributed less than $20,000 to it over that period of time, had over $1 million. I actually got to witness him taking $100,000 out at a time back in the late 1990s. We'd come back 2 or 3 months later, and his account would be back where it was. You know, again, pretty cool thing to witness. But the thing we take away from it is over this 60-year period, the Mutual Club of Detroit, at least for Tom's account, generated this incremental return above and beyond the stock market. And again, the stock market here was measured by a blend of the S&P 500, and then before that even existed, the Dow Jones Industrial Average. So we can come up with that number. Again, that incremental return is actually huge. And one of the points that Tom and some of the gurus used to like to make was they weren't doing anything exceptionally fancy or had no special secrets or gimmicks, and that they knew of many people within the community that actually achieved better results than that. And on the flip side of that, when we did the studies back around the year 2000, we found more often than not the worst performing investment clubs, the ones that seemed to be a little bit unfortunate, came in at worst. The worst case was like -2% when it comes to relative return, this relative return. So again, we're talking about over the long term, an investment coming in at 6, 7, 8% per year. I have a hard time calling that failure. I mean, I basically think of stuffing the mattress versus that as failure or real risk. So again, the bottom line here, the relative return for the Mutual Club of Detroit over 6 decades is somewhere between 3 and 4% per year, percentage points. So again, 300 to 400 basis points per year. Another probably equally famous club that came around in the 1980s and became a little bit infamous back in the mid-1990s, more on that in a minute, it's the Beardstown Ladies. What you see here is the Beardstown Ladies performance between 1983 and 1997. They, of course, became embroiled in a controversy spurred on by Disney, and a certain percentage figure on the cover of their book, that 23.4% figure, actually turned out to be an honest mistake, an error made by Betty, one of the ladies. Betty thought she was actually looking at 12 or 13-year performance in the club accounting package, and she actually was mistakenly looking at performance over, I believe, 1990 through 1993, so that's where the 23.4 came from. I mean, it was real, but it was reported inaccurately. Personally, you know, with my experience as a magazine editor, and I certainly understand fact-checking and all that kind of stuff, I hold Disney mostly responsible for that honest mistake. They really should have caught that. But that's really not the story. And this is the story that you're about to hear is one that is just not told. It's never been reflected in anywhere in the press. We certainly celebrated it during the 50-year anniversary of the National Association back in 2001. But when Price Waterhouse actually checked in and audited the results between 1983 and 1987, what they found was a really decent relative return. The annualized return during that time frame was still 15.3%. And then this little fun fact that the ladies, despite all the heat that they were taking in the media and in the national press, they did manage to outperform 5 out of every 6 stock equity funds over that period in question. So again, we're talking about the relative return, this 1.5% number, this incremental amount better than the market. And again, that may not seem like much, so we want to work hard to put that in context. But I've actually had the privilege of visiting the ladies. They actually meet in the lower level here at kind of a town hall meeting area. And for those of you that are history buffs, this is one of the Carnegie libraries. You can see that up here at the top. Put a bunch of libraries built around the country. This one was ultimately converted to the Beardstown City Hall, but just kind of some fun facts. And oh, by the way, this window is actually the window to a courtroom where Abraham Lincoln practiced law. And in fact, he launched his 1860 presidential bid in Beardstown. Some kind of fun facts there. So let's reach for some context. Let's reach for some, you know, what do those numbers mean? How do we think about them? You know, only 1.5% from the Beardstown Ladies, question mark? Well, 1.5% is actually pretty special. And we want to kind of put things in context here with a couple of glorious examples that we hear about so much in the press. First of all, starting with Peter Lynch and Fidelity Magellan, one of the best investing performances on a relative return basis. Again, we're talking relative returns, basically taking the actual annualized returns and comparing them versus the stock market at the time, hence relative. And from 1977 through 1990, I believe the number is like 29% per year. It's what Peter Lynch and Fidelity Magellan were able to achieve. So again, subtracting out the market performance, we get this 13.4% per year relative return, and basically 13 years starting here, and a return of 13.4%. So that's the X and the Y, 13 years. 13.4%, we get this point. By the way, we refer to Wall Street analysts and institutions as rhinos, so we put some honorary rhinos on here. We call them rhinos. I'll give the nutshell version. You can certainly read about it at Manifest. And by the way, if you do a search on the word rhino, Kurt has actually engineered it so that the definition comes up and you get a link to the article about it. But the nutshell version is we call them rhinos because we know that the field of vision of the actual rhino on the savanna in Africa has been estimated at 30 to 40 feet, whereas they're capable of running at speeds where National Geographic has clocked them up to 45 miles per hour. And but wait, it still gets even better. You can't make this stuff up. A group of rhinos is actually referred to as a crash. So again, that's a term of affectionate endearment. We actually are grateful for the opportunities presented to us as long-term investors by the rampaging crash of rhinos from time to time. Speaking of another beloved rhino, Warren Buffett over here on the right, he's the guy kind of towards the front of this picture. If you take a look at the performance of Berkshire Hathaway, and I believe they'll be meeting and discussing this a week from today, if you take a look at the last 20 years, that's what we took a look at. That's what's shown here, last 20 years. Berkshire Hathaway is up, and again, relative to the market over that time frame, at an incremental advantage of 6.6%. So again, that's a huge number. May not seem like a lot, but 6% is huge. So we've talked about the mutual club being between 3 to 4%, the Beardstown Ladies, which are right here at 1.5%. And that kind of sets the stage for a little bit deeper look going across the board. By the way, we'll probably be talking about some of these other guys. This is Bill Ruin from the Sequoia Fund. Charlie Munger is here at the back. This is Charlie right here. Charlie is Warren Buffett's lieutenant and I believe co-chair or almost co-CEO of Berkshire Hathaway. And then this guy on the right, we're going to talk more about him in a few minutes. His name is Walter Schloss. And we'll be talking about Walter here in a few minutes. All right, let's take a few other closer looks at some performance indicators, kind of filling in some dots. You see, again, here's Magellan and Peter Lynch still up here. Here's Berkshire Hathaway. So they've been kept here. The Beardstown Ladies are somewhere over in here. Excuse me, they're over here now. Some other ones that we might talk about. Ken Hebner has been a hot mutual fund manager here over the last several years. He's at a plus 8.5% over approximately 10, almost 11 years. That's what's represented here. And Hebner is certainly one that we track and keep track of. By the way, that is the Beardstown Ladies there to the right. The NAIC Growth Fund, I found this kind of interesting. The NAIC actually spun this growth fund off, sold it to third-party investors known as American Eagle Capital, and even since that time frame, over the last 8 years or so, they have a plus 2% relative return. That's actually pretty cool. Another fan favorite for us is Ron Mullenkamp and the Mullenkamp Mutual Fund. It's a very diversified, small, medium, and large type fund. We'd like to see it do even better, but again, over the last 14 years or so, that checks in somewhere around 2%. By the way, since Peter Lynch left Fidelity Magellan from 1991 to the present, Fidelity Magellan is at a relative return of 0. So basically, they've kept up with the S&P or the general stock market. And then just one thrown in here for kicks, Janus, operating at 0 over 17 years. So again, we're starting to get a little bit more context. And by the way, as you see these red dots as shown by the rhinos, we also know that for every one of those dots, I could just as easily find anywhere from 5 to 6 or 9 to 10 to put down here below 0. That's basically what will shake out. Here's a few more things to look at. Starting with this one here, this is the Yachman Fund, 10 years, almost 6% returns. Sequoia, Bill Ruin, that I mentioned here a few minutes ago, 15 years, somewhere between around 4% returns. How about this one, Acorn? Acorn is Ralph Wanger's fund. It's a small cap fund that has just performed spectacularly well over an extended period. Here we see Acorn comes in at 20 years and about incremental return of, relative return of about 5%. That's all pretty cool stuff. We'll probably spend more time talking about this one, especially in terms of how we characterize or how we think about 1, 2, or 3 year performance. This is Bill Miller in Legg Mason Value. And he actually has extremely strong performance going back several years. But if we look at just the last 8 or so, you can see he's suffered. In fact, he's no longer running that fund as of just a couple weeks ago. And I kind of saved the best one for last, at least in my opinion. One of my favorites as I've begun to follow some of these legends and learn a little bit more about them. This is Walter Schloss. He's mentioned in the Super Investors of Graham and Doddsville by Warren Buffett, one of the best papers ever written on the subject of investing. You can see here for a period of 28, almost 29 years. Again, 28 or 29 years, he checked in at a relative return of 8 to 9%. And by the way, he had another partnership, same time frame, that actually came in 10 percentage points higher than that. So, I mean, up here off the chart. So for the period 1956 through 1984, Walter Schloss actually delivered nearly 10% returns for nearly 30 years. just fascinating if you think about it. We certainly want to dig in and understand that even better. We did actually throw a few of the major, most widely held funds that have the highest amount of total assets. Here's American Washington Fund, again 15 years, pretty close to zero. Here's Fidelity Contra. This represents 19 years. Fidelity Contra is one of the best performing larger funds out there, most widely held funds out there. So they're kind of starting to fill in here a little bit. And again, just to give context, and this is what gets us just hopped up excited about the stuff that we're doing from left to right here. Again, blue means it's affiliated with either a club or something that we do. This is Solomon Select. Again, going on 7 years, checking in at between 1 and 2% performance. I'd like it to be a little bit stronger. We're certainly shooting for 5 to 10 and hope to get there. The Manifest Investing 40, the Manifest 40, that's your 40 most widely followed stocks, and this is just simply cool. We're going on 7 years or so, checking in at that 5% threshold. Really like that a lot. The Challenge Club. Challenge Club has actually been in operation since the late 1990s. The returns are between 4 and 5% on a relative basis. Again, that's just no way around it. It's cool. And this is the one you've heard us talking about here a little bit lately. Tin Cup started in at the end of 1994, so it's literally been running since 1995. Tin Cup, that same model portfolio that we report on every month in the newsletter, since 1995, going all the way back to that time frame. We're talking about returns that are almost Lynch-like, that are in the 13% relative return range. And again, that's a portfolio that we air out and discuss the decisions every single month in our newsletter. So we just encourage people to follow along with that one. Some pretty good stuff going on there, and it's really managed in a pretty direct and simple approach. Just to give a little bit more definition to what some of those are about, here's the Manifest 40. This is as of the most recent update. You can see that the most widely followed stock by all of you guys is Stryker. Then we also noticed that Apple has moved up the list rather dramatically up to the number 2 slot. It has incredible returns since 2008, 2009. That's when many of you were tracking it or accumulating it. And then just some real industry stalwarts or community stalwarts from Abbott Labs, Microsoft, J&J, Aflac, Walgreens, Pepsi. We recognize most of those as core holdings. And a few other companies that have actually dribbled in, like Quality Systems would be one. BioReference Labs, one that we've had a lot of fun with here over the last year. Cognizant was kind of off the screen a few years ago. Oracle's been a long time solid performer. Again, you just see Fastenal, another one that's been quite good to us. So again, some of these smaller companies have actually delivered some pretty exciting returns also. So again, we're talking about an annualized rate of return over the last 6.5 years of 7.4, and again, a relative return of approximately 5% over that time frame. And 3 out of 5 of the Manifest 40 are outperforming the Wilshire 5000 during the period that we track them. So some pretty cool stuff going on, and we think actually some pretty exciting stuff going on. Here's a look at the performance of that Tin Cup, and I've gone back to the time when we actually began publishing the Manifest Investing Expected Returns monthly newsletter. And again, this is a slide that many of you have seen. The reason that we've been kicking it around is because we hit this $1 million moment not too long ago. And again, think about the power of what this suggests about what might be possible, and it comes right down here to what are we demonstrating. And again, going back to January 1995, we've simply taken, starting at 0, without any company matching, starting at 0, we've invested the maximum available, maximum possible amount into a 401k every month since January 1995. So that actually adds up to a total over these 17 years of about $200,000. That $200,000, again, put in monthly over the last approximately 17 years, is now worth, well, this week it's actually down to about $970,000. You can track that continuously on the Manifest Investing homepage. But It did reach that $1 million moment approximately a month ago. We're kind of creeping back towards $1 million again. And by the way, every time we hit $1 million again, Kirk breaks out the ice cream and we celebrate again. But the real power here, in my opinion, is, as I describe it there on the right, we would describe this portfolio and this demonstration as Slashian. And it is kind of a tribute to Walter Slash, because as you dig in and read the stuff about Walter that Warren Buffett has shared with us, he basically used value line, and almost exclusively value line, for his work. And basically, again, as the words there say, he practiced investing just like all of us. All of us are ordinary investors. I would say we're better than average investors in that we basically build expectations. We form expectations. And that's the answer to the question. Why are we here? We're basically here to build realistic expectations, and that's what kind of sets us apart from the rest of the investing world out there. So basically, here's what the picture boils down to. The red ones again are the institutions. The blue ones are community-based examples. We're going to talk about more of this in the session that follows this one at 11 o'clock Eastern time. Fill in a few more clubs just so you get the idea. But again, keep in mind that for every one of these red institutional or rhino dots that you see up here above 0, there literally would be, let's call it 8. For every one of these, there'd be 8 down here, and we'll show that. We'll actually put together a slide which shows that here in the not too distant future. But it gets pretty crowded down here in the red zone. Probably call it the red zone. The red zone is populated by many of the professionally managed funds, and just simply not a pretty picture. And what we will find as we build out the collection of investment clubs, that a lot of times these blue dots, that's not to say there will not be some blue dots down here, because there will be. There always will be. But as we see a large number, a disproportionate number of the blue dots up here on the top half of this screen, we really look forward to exploring what that means. So, and it really does boil down to that simple question: how is this done? How do we do this? We want to provide some reinforcement for that. Well, here it is, literally the answer to the question. And probably the most important word that we've used this morning, or will use this morning, is this one right here: imagine. And this is what sets us apart from the average investor on the street. That, of course, is Warren Buffett on the left. And basically, in our opinion, we basically invest in the same way that he does. And again, we're not putting him on any type of artificial pedestal. He basically came around after George Nicholson, the founder of the modern investment club movement. And but just listen to his words. I mean, this is how he describes making an investment decision: literally putting his feet on the desk, closing his eyes, taking a deep breath, taking a sip of cherry Coke. He owns 10% of that company, or at least Berkshire Hathaway does. And literally think about, what will this company, again, based on the track record of the company, where they've been, where they seem to be going, what might this company look like 5 years from now? Well, how different is that from what we do? I mean, we basically take and develop an understanding based on the history of the company on the left side of our analysis, and then we form this vision of where this company might be 5 years from now, and then ask the question, well, if that all comes to pass, what will the company be worth? So how different is that? And the answer is it's not different. We basically try to build an image or an understanding, an expectation of what the company will look like in 5 years. And again, this is, in my opinion, one of the key success factors that sets us apart from the vast majority of the investing world. That, and armed with just the stark reality that our method of calculation is simpler than what most of the MBAs and CFAs and everybody else out there does. And that's why we included this slide in here. A friend of mine out in Seattle sent this to me a few months ago, and he said, I've been teaching stock selection guide classes for several years now, and I swear that many people in the audience basically see the stock selection guide as something mirroring this picture on the wall. And by the way, I I can actually remember when I did stuff like this back a couple decades ago at the University of Illinois. Probably scary. I don't know who that guy actually was anymore, but this is the type of picture that many people, when they come to us, they see this fairly complex, challenging puzzle. And again, keep in mind, we're all wired differently. Everybody's going to see this situation differently. I mean, there are engineers out there that really latch onto this stuff, accountants, but we're all wired differently, left brain, right brain, all that stuff. So we have to continuously seek alternatives to keeping this as simple as possible. This is the way I think of it. This is what I would term an effective stock study, especially stock selection guide enabled or guided stock study. We really think in terms of that picture we had up there with Mr. Buffett and the word imagine. The picture that we're building, the vision of the company that we're building when we do a stock study is basically the answer to those three questions. You know, what is a reasonable sales growth forecast for the company first? Fill in the blank. How profitable will they be? And you can use whatever form of profitability you like to measure. We use percent net margin in the stuff that we do. So percent net margin. And then what PE? What PE would be a reasonable P for this company over the long term? And basically those three blanks, filling in those three blanks are the essence of what we do during a stock study. Here it is in visual form. And we basically build expectations. And again, if the numbers make you crazy, if you're a person that's wired a little bit differently, here's a picture. And the picture is basically we take a look at the longer term trend. The history of the company over here to the left is all historical. The one thing that we do different at Manifest Investing is we include a couple years of analyst estimates for both sales and earnings, but we basically use both of those to build an understanding or an expectation for the long-term trends. That's what you see here, the long-term trends for the company. So again, it's nothing more difficult than honoring a 5-year time horizon, building long-term trends. And the trends are of the top line, which is sales or revenues, and the bottom line, earnings, or basically the profit of the company. So the difference between these two lines, as it says here in the box, the difference between the two lines is the profitability of the company, the relative profitability over time. So in this case, you see some fairly interesting things going on. And we'll be talking a little bit more about that. Nicholson, Benjamin Graham, David Babson, Phil Fisher, Warren Buffett, certainly, a whole number of legendary investors talk an awful lot about patience, discipline, and also this understanding of quality. And it's, you know, why is quality so important? We're going to talk more about this later, but quality basically is one of your insurance policies that protects you against bear markets, recessions, and deep corrections. The higher quality companies behave better during challenging times in investing. And at Manifest Investing, we basically took the works of Benjamin Graham, who was Warren Buffett's teacher, George Nicholson, and boiled them down into 4 factors. And those 4 factors are shown here. And they're not meant to emphasize any one over the other. All 4 matter here. But the financial strength of the company, the consistency or stability of earnings, and then a couple of competitive comparisons, peer comparisons or industry group comparisons, where we take a look at the growth forecasts and the profitability forecasts for any company and compare it against their peers or competitors. And basically take those 4, stack them up into one single rating so that we can assign a quality rating and basically rank all 2,500 companies that we follow. So that basically we're looking for the best of the best. Nicholson taught us to invest in the industry leaders, buy them when they're on sale. And this notion of quality is also an important factor. As Benjamin Graham says down here at the bottom, we're talking about excellence. We're talking about superior management, a superior comparative record over time, consistency, delivery of results, accessing fields of opportunities. I mean, think Apple in the current landscape. So that's what goes into the quality rating. You can almost think of the quality rating, for those of you that are familiar with the better investing approach, almost like a scored stock comparison guide for all the companies in the universe that we follow. and a scored stock comparison guide where you're constantly seeking the companies that have the strongest attributes, especially when it comes to the four shown here. So as we said back with the Manifest 40, the Stryker is the most widely held, probably most widely followed and probably most commonly held stock in our community. If you take a look at Stryker, study the company carefully, it would be reasonable, in my opinion, to come up with an annualized sales growth forecast somewhere in that 7 to 8% range. So we check in with a 7 to 8% expectation at a profit margin of, let's say, 18%. And then based on the history and some of the expectations for the company, I might even go a little bit higher than this if I was forced, but a PE of 15. Those three answers literally combine to form a price appreciation from a current price somewhere around $54 up to a 5-year average forecast price of 86. To go from 54 to 86 over a period of 5 years, remember it's our constant 5-year time horizon, that would be 10% per year price appreciation. Add in about 1% for dividends, we're talking about a company that has a return forecast of 11%. So literally any company that we follow, we basically try to come up with those 3 milestones and build that return forecast. In the case of Stryker, we're talking about 11%. Here's how it's presented on Manifest Investing in the company page. This is Stryker. You can see the stock price is 54. Very high quality company. Anytime it's color coded in blue, that means it's in the top quintile, top 20% of all companies. And the projected return again checks in at approximately 11%. And here basically are the numbers that fall into that income statement. You could think of it as a business model type situation, business model analysis. We basically take these 3 or 4 key factors and we share with you what those assumptions are. The trailing 12-month sales, we say current. When we say current, we basically mean trailing 12 months. We may actually include 1 quarter of estimates if we're near the end of a quarter. But current sales, that's the 8442. The 7.6% actually shows up here in the calculation 5 times. Shows up here 5 times. Okay, so that's how the growth actually factors in, that 7.6 growth rate. All right, and then the net margin or the profitability shows up here in the calculation also. The denominator consists of an estimated number of shares outstanding in the future. So literally the trailing 12-month sales are combined with a sales growth forecast and the net margin on the top line divided by the projected shares outstanding on the bottom line here to come up with a 5-year earnings per share forecast. By the way, that's the other academically correct answer to why do we do stock studies. We do stock studies to come up with a forecast of future earnings based on an understanding of the business model. So again, once you've got that 5-year EPS number, take a look at an average PE ratio of 15. 575 times 15 comes out to be $86. And then you can literally take a financial calculator if you want. Obviously, Kurt and the stuff goes on behind the scenes at Manifest to solve for the annualized price appreciation. Again, going from 54 present value to 86 5 years out, always 5 years, and solve for that annualized appreciation rate, approximately 10%. That's what you see here. So that's basically the calculations that are going on for any and every company. You can see the core assumptions for any company by going to any company page. We can certainly do some of that if the audience would like to. The bottom line is the return forecast. We like the projected annual return, and in this case we're talking about a company with a 10 to 11% annualized return forecast. To give that a little bit of context, here's what it looks like over time. Here is Stryker going back to the year 2000. Basically, the value line low total return forecast is a first cousin. We'll just leave it at that for now. We're basically looking at the low total return forecast over time. You can see that it's been as high as upper 20s back in the teeth of the Great Recession, back when the stock price, that's what the green bars are, reached these pretty herky-jerky low levels back during spring of 2009. pretty good time to buy the company, and that's turned out to be a pretty good situation, going from the 30s up to nearly 60 at one point in time. But again, the point to be made is the stock prices fluctuate, so do return forecasts, and we can use them as guides to buying and selling and taking care of our portfolios. You can see that under current conditions, there's actually been a slightly weakening of fundamentals at Stryker here over the last few months. We're actually operating or looking at a company that's, at least according to Value Line, fairly timid expectations compared to what it has been in recent quarters and recent years. Certainly one that I'd be a little bit reluctant to accumulate if held in a portfolio.
Mark, we have a question from Laura Scott.
Yep, go ahead.
When your stock price reaches par before the 5 years, would you go ahead and sell or buy something else?
If the stock price reaches the par
in the question, but if it achieves that relative return, I suppose, or that expected return.
Yeah, and I guess the way I would frame the question, Laura, is I'll paraphrase it a little bit or clarify. I think it's important to think in terms of return and kind of stay away from price, at least as a first level of emphasis. We basically take and break down every company into a return. That enables us to compare and make a judgment about whether a company is expensive, whether it's at 8 or 80. In the case of Apple, it's at $600 a share. In the case of Berkshire Hathaway, it's at $120,000 a share. So it really isn't the price that really nudges us either in the decision mode of buying or selling. It really is the return. And what we encourage people to do, and again, this, I've been at this for 20 years within this community. I do think that again, prior to the advent of the computerized tools, it was tough. It was tough to do study updates and that sort of thing. We had people that would literally take an original stock selection guide and only update certain parts of it and all that kind of stuff. You don't have to do that anymore. You can literally watch, and in the case of Stryker, you can watch as the price changes and as the fundamentals, underlying fundamentals change. What is the impact on the return forecasts, the projected return over time. Some companies tend to operate in a fairly narrow band. Your Aflacs, your Johnson & Johnsons. Others, Cisco, the computer company, are pretty volatile. And the answer to the question is, there really isn't. It's a 5-year time horizon for purposes of the calculation. It's really not any type of an objective, and that's something that we've kind of mangled over the years. If I reach my target price 2 years into my 5-year time horizon, what should I do? And my answer would be, well, it depends on what the return is, the projected return is at that time. And again, keep in mind that we think that should be continuously monitored, and something that we do for the companies at Manifest Investing. So I don't know if that answered your question. Please clarify and come back to it if you need to. But yeah, it's focus more on the returns. And again, the other thing that we hear mangled in the press, I'll get on the soapbox a little bit. We often hear that Warren Buffett's holding period, he basically buys and holds stocks forever, and that's really a journalistic mangling of the facts. What Buffett says is he likes, his favorite holding period is forever. That doesn't mean that he wouldn't sell a stock. He'd sell Coca-Cola tomorrow morning if you offered him $200 a share for it. He's basically, his favorite holding period is that company which just simply percolates along, very much like a Coca-Cola, where, the projected return is consistently somewhere in that 10% plus or minus, not too many percent at any given time. And you literally can have a situation where you can hold a company as it continues to grow and basically hold it for, next to forever. That does happen, but that is his favorite holding period. He is willing to sell stocks. He's sold a number of stocks here in the last couple of years, and so he doesn't buy with the intentional holding period of forever. He simply hopes that that's what happens. So again, as Nicholson taught us, it's not buy and hold, period. It's buy and hold for as long as it makes sense to do so. And again, in the cases of Procter & Gamble's, Coca-Cola's, and a few others like that, sometimes that can be, especially if if you pay attention to the returns and get in at the right price levels to begin with, it can approach forever. I mean, I have stocks that I bought back in 1993. I'd be willing to venture a bet that Dan Hess has a few stocks that he may have even bought in the 1960s or 1970s. So it can happen, but again, it's not done. It's only a matter of holding them for as long as it makes sense to do so. Anything else at this point, Kurt?
Nope, no questions at this point.
All right, so let's continue talking about, again, the community. And thought we might take a look at a company from this list. This list is actually a public dashboard that you can look at from the homepage through the published dashboards at Manifest. This is the heavy hogs for 2012. We have a stock picking contest that runs from February 2nd to February 2nd every year. This would be the current collection of consensus favorites for this year's crop. And you can see that it includes Apple, Buffalo Wild Wings, and some that have done swimmingly well, and then a few that have been laggards. Down at the bottom, we see Mercado Libre, Schlumberger, which we recently featured just last month in our newsletter. Quality Systems has been a little bit slumpy. Carbo Ceramics down there at the bottom, those are companies that would kind of draw my attention, but all in all, a pretty good performing list and an interesting source of ideas. I'm going to be talking about other sources of ideas, including this one this afternoon in the stock screening stuff. What I thought we would do here is just kind of grab one from somewhere in the middle of the pack. My attention was drawn to Masimo. It's a company that we have featured in the past. It's got a decent projected returns in what we call the sweet spot, which is 5 to 10 percentage points above the average stock on the stock market. And all these companies have exceptional quality ratings, so excellent quality ratings from top to bottom. That's typical for a better investing influenced audience. And but in this case, let's kind of dig in and prepare a return forecast for Masimo from start to finish. A little background on the company. They make some very interesting stuff. The key word for me here is this one. I have a couple sisters who are nurses, and they really like non-invasive. Anytime they can do things without making a hole in patients is something that they really like. We also know that some of the advances that have been made here over the last several years for early detection of oxygen problems and monitoring of blood and all that kind of stuff that is done in a non-invasive way is pretty cool. You see the nurses station here with what looks to be about, what's that, 5 by 6, 30 patients. Their vital statistics are all right there, and all being done non-invasively. It's pretty good stuff. So what we literally want to do is confirm some of the stuff that we see generated by the Rhino-driven forecasts at Manifest Investing, and take a closer look at Masimo. We do encourage people within the community to become aware of, and at least as a strong second opinion, the low total return forecast. You heard me mention a few minutes ago on Stryker, the low total return forecast for Masimo according to Value Line. And again, this is a 4-year horizon, so some of these numbers are going to be different because it's 4 years, not 5. But this number over here is annualized, so it's something that can be compared. 20% annualized total return. That would include dividends for any company. Masimo doesn't have dividends, but it would include dividends. So 20% is a good second opinion. So if you do a stock study on Masimo, you get to the bottom line of your stock selection guide, and you're in the return forecast section in section 5, your number should probably be fairly similar to that 20% number. And we will be presenting here sometime in the near future why we like the 20% more than 34%. The answer is because that forecast matches actual going back over the last 30 to 40 years. So what we want to confirm for any company, again, is those 3 major milestones. Those 3 major moments during the study of any company: the growth forecast, the profitability, and the projected average PE ratio. In the case of Masimo, you take a look at a relatively abbreviated actual history for the company. coming public back in 2006, 2007. For a company at this stage of its life cycle or growth cycle, we would tend to pay much more attention to the right-hand side of any history. So we'd want to emphasize the right-hand side of this picture. We have a couple years of estimates in for growth for Masimo. You can see they're pretty much right on this trend line. And basically using these 5 pieces of information, three historical numbers, and then those 2 analyst consensus estimates for the year ending 2012 and year ending 2013, we get an 11% sales growth forecast for the company. So we literally go through for all 2,500 companies behind the scenes and make this type of an assessment to come up with whatever number that you see here. So 11%. It's always regression based, and it always includes whatever analyst estimates are available. How about the profitability for the company Masimo? Again, solid company. The profitability long term, you can see that they came out. You could almost ignore this as probably fairly early history. And since that time frame, they've basically been at right around 15%. 15% for their net margins. Interestingly enough, Value Line's 3 to 5 year forecast is for 20.6. And again, this is an area where, gosh, we hope they're right, especially if we're shareholders of Masimo. But that's a lot of optimism to go all the way up to the top of this chart in the next 4 to 5 years. So we'll stick with 15. 15 is where it's been. Hopefully the Value Line analyst is right, but 15 sure looks good to me for a study for Masimo. And last but not least, the third major milestone, what type of PE should we use? We know going from left to right for a company, again, at this stage of its life cycle, we would expect PEs to be dropping as the growth rate naturally slows down and the company matures a little bit. You can see that Value Line has a 3 to 5 year estimate of 25. The current PE, they've been under a little bit of duress, is down around 18 or 19. Standard & Poor's checks in with an opinion at in the low 20s. So basically at Manifest Investing, we try to factor in and we build a consensus type aggregate of S&P, Value Line, Morningstar, a few others. Take a look at the industry, a few other things, but we come up with, okay, 24 is okay. Might even go a little bit more conservative than that, but we'll keep 24 for now. You can actually go to MyStudies at Manifest Investing and do your own audit of whatever the analysts or the rhinos are thinking. And again, keep in mind that we're auditing against that one opinion known as Value Line, that 20% number. Again, the left-hand side of this is going to be a current day income statement. The right-hand side, just like Mr. Buffett is there on the right, the right-hand side is going to be what this company might look like 5 years from now. Again, that vision of what the company might look like. In the case of Masimo, we're talking about a company, relatively small company, at a little over $400 million in sales, growing at 11%, just like we talked about. 15% net margins, not 20%. That's the main difference between the number we're going to get in Value Line. A PE ratio of 24. Again, if I'm doing the study myself, I'm probably using 23, 22, and still making sure that it still looks attractive under those conditions. And a 14.9%, call it a 15% projected annual return using those 3 core assumptions. And fairly dramatically see a pretty quick correlation. Of course, the difference between our 15 here and the 20 is the majority of it is in the net margin assumption that Value Line had a couple of slides ago. So with that, we'll just kind of summarize. The foundation of literally everything that we do is this notion that we develop return forecasts and visions for our companies 5 years out. Then we watch for threats and opportunities to those visions, but we develop these expected returns. So we do encourage continuous analysis with an emphasis on the return forecast as the bottom line of any stock study, and we encourage people to develop credible and achievable or feasible forecasts for those 3 major milestones. And again, the 3 major milestones are the growth forecast, the profitability forecast, and what the PE ratio will be in the future. Simple as 1, 2, 3, or GPV if you want to use valuation there. And again, our notion that at Manifest Investing and within our long-term investing community, it really is the bottom line result of any stock study. And when it comes to not only shopping or assessing the condition of an individual company, it is one of the most important design factors for what we do with portfolio design and management as we deploy it within dashboards. So it's crucial to understand how we measure these companies and how we track them for any necessary actions.
We had another question, Mark.
Go ahead.
How often do we reevaluate return forecasts due to changes in companies' fundamentals or outlooks?
All right, our default condition, that's a great question. Thanks for the question. Our default is to basically attempt to do them, and it's certainly absolutely true for the value line 1700 companies, which are going to be the most commonly followed companies. For the companies in the standard edition at Value Line, we do it within every 3 months. We follow the 13-week cycle, and that's the basis for our weekly message that we put out every week now. We basically are looking at 1/13 of that 1,700 companies and shopping for opportunities within that. So the default condition is once a quarter. Now, if during an earnings release or news flash from the company or whatever, or an update to the analyst consensus for any company, we might do one between those updates. In the case of the Manifest 40 stocks, the companies that we had up there just a few slides ago, we do up those, I would say, approximately every month, where we watch for or monitor for changes in the analyst consensus estimates for any company. So we do watch those a little bit more closely. And we attempt to get all companies updated every quarter. Some of the smaller companies do lag from time to time, but quarterly is the default answer. All right, I think I'm going to go ahead and basically say thanks for coming out this morning. We do have a couple more sessions today. Hope to see some of you, if not all of you, at that. And we'll certainly stick around for a few minutes, but I'm going to go ahead and stop the recording now. Thanks, everybody.